Welcome again to another Financial Indicators by Fahad M. Goha. This is going to be the video number 11. The subject of today of this video is the non-manufacturing PMI, which is service PMI. The non-manufacturing Purchasing Manager Index PMI, often referred to as the service PMI. Now, what it does, it measures the performance of the services sector. These sectors, of course, include industries like retail, finance, healthcare, and technology. The index is calculated based on a survey from purchasing managers on these industries. Of course, focusing on key metrics such as new orders, business activities, employments, and supplier delivery time. Of course, a high PMI might encourage businesses to invest and expand, hire more staff, or increase production capacity. But declining PMI might prompt companies to cut off costs by reducing inventories or delaying expansion plans to mitigate the impact on the economic outturn. Now, let's see how we categorize this service of the PMI. If it is around 50, we would say it reflects no change, which indicate a stable servicing environment. But if the PMI it's below 50, it suggests contraction, pointing of course to economic slowdown. If it is above 50, then it indicates an expansion in service activities, signaling economic growth. Now, let's see what's the impact of that high PMI, which is above 50, in comparison to low PMI, which is going to be on the next slide. So let's go with the high PMI first. On the market confidence, a high service PMI suggests a robust economic activities in the service section or sector, boosting of course investors and consumer confidence. Investors usually use this data to assess overall economic health, adjusting accordingly their investment strategy with that, which means the market confidence here will go up. How about the interest rate? What will happen to it when we have a high PMI? Rising service PMI often signals increased economic activities and potential inflationary pressure. Of course, when pressure happens, what happened to the interest rate? When inflation start creeping up, it creates pressure. In response, of course, central bank at that point interfere, and consider raising the interest rate to control that inflation, dry up the market from funds for a while. So the interest rate will go up. What about bonds? What will happen to the bonds? Of course, the bond price will fall. Why? Because when you raise the interest rate, the new bond yield might rise, as investors expect, of course, central bank to tighten, monetary policy to manage inflation, which means the new bond will have a higher interest rate. The older bond, will be out of favor, and interest rate will lead those bonds to their prices to fall off. So the bond price will fall off. How about the currency value? Currency strengthens based, because it's of course the currency strengthen. Why? Because it indicates a robust economy. You remember, your PMI is above 50, which will attract foreign investment, and that will increase demand for services, which might drive up, of course, prices and lead to higher inflation. So the currency value will go up. What about government debt? A high PMI value can ease government borrowing, of course, because pressure, since economic growth will lead to higher taxes and revenue. So government doesn't need to borrow money, so their debt will go down. What about the stock market? Okay, stock market will rise. A strong service PMI indicate healthy corporate earning and potential for, as a potential, which will drive, of course, stock market higher. So stock market will go up. What about the corporate earning? Of course, corporate earning is related to the stock. You know, the PMI is directly linked to corporate earning in the service sector. A higher PMI suggests that companies, are likely to see increased revenue and profit. So the corporate earning will go up. So now let's go and see what will happen when we have a low PMI and how it will affect those aspects we just have discussed. Let's go. First, with the market confidence. A low PMI indicate a slowdown, which can result in a lower market confidence. So market confidence goes down. What about the interest rate? A low PMI, could lead to a lower interest rate. Why? To stimulate economic activities. Because when you have low economic activities, the central bank interfere, to pump money into the economy. How? By lowering the interest rate, so people will have more cash, and that cash will grease up the market and fuel up the economy, because people need money and cash. With low interest rate, there will be plenty of money available for everyone. How about the currency and inflation? Of course, a low PMI weaken the currency as it reflects economic difficulties, and potentially, of course, lower the interest rate, because that's very important for that reason, which will indicate weak demand, which can reduce inflationary pressure. So the inflation, the currency value will go down. What about the government debt? A lower PMI value might result in higher government debt due to decreased tax revenue and increased government spending to stimulate economy. So the government need to borrow more money to stimulate economy, because the collection of taxes is much less than what was expecting. So the government debt goes up. How about the corporate earning? A lower PMI can signal declining sales and profits, which affect, of course, overall business operation. So the corporate earning will go down. What about the bond? The bond will rise here. You know why? Because it's a safe investment. A lower PMI might result in a falling bond yield, for the existing bond, as a central bank, of course, cut the interest rate to support the economy. So people or investors will be, pushing those bond prices higher, because they are looking for those bonds as a safer investment. And the interest rate is low, means the bond will be issued with a lower interest rate. Investors always look for safe investment, so the bond prices will go up. What about the stock market? Of course, stock market will fall. A declining PMI might signal economic troubles, which will reduce investor optimism and lower the stock prices. Stock prices here will go down. Now here, this is side by side for both what we have just discussed in the previous two slides: high PMI versus low PMI. And this way you can do an easy comparison. Now let's look at this chart and just visualize what we just have discussed. See, this is the dates here, the year from 2020 to 2023. And this is the value, and you can see the service PMI and its economic impact on the stock price. Stock will be this green here from 2020 to 2023, and you can just see the rest of them, and see how the service PMI affected all these aspects. So I hope this video was very helpful for you to understand the issue or the service PMI. See you in the next video.